The next presentation we have is financial security. And again, that is by me. And I work again at the National Indian Council on Aging. Before I came to the National Indian Council on Aging, I have about 35 plus years working as a tax professional and doing small business and individual tax returns and helping people with Social Security and Medicare. So this afternoon, I'm going to be giving you some basic information about Social Security, tax planning for the upcoming 2020 filing season, and basic Medicare information. Next slide. So that's what we're going to talk about. Next slide, please. So let's start with Social Security. This is what you need to know. So how does Social Security work? Well, Social Security replaces a percentage of a worker's pre-retirement income based on their lifetime earnings. So the portion of your pre-retirement wages that Social Security replaces is based on your highest 3 to 5 years of earnings, and it varies on how much you earned over the course of your working life. And how much you earn and when you choose to start your benefits all will determine how much you get in Social Security. So there are some eligibility rules. You're eligible when you work and you pay Social Security taxes, you earn credits toward your Social Security benefits. You need 40 credits in order to qualify for Social Security. That is usually 10 years of work approximately. And a worker receives 1 credit for each $1,360 earned in 2019. This amount is adjusted each year for cost of living. The amount of earnings needed for a quarter of coverage increases automatically each year, and a maximum of 4 credits may be earned in any given year. Now, you can, if you stop working before you have enough credits to qualify for benefits, your benefits will sit on your Social Security record, and if you return to work later, more credits will be added. And they will continue to be added. But Social Security won't pay any benefits out. They can't until you have worked the entire 40 credits. So it's important to check your Social Security as you're working. It's never too early to start looking at your Social Security and start planning for when you retire. Even somebody that's 20 years old needs to take a look and see where they are. The elders and people starting at age 50, it's imperative you start looking at your retirement to know, kind of plan where you're headed. So now you're eligible, you know how you're eligible. So when are you eligible and how do you find that out? Choosing when you start receiving retirement benefits is your personal decision. The age you begin collecting your retirement benefit affects how much you will receive. There's 3 important things to know about age when thinking of when to start your benefits. You can start benefits at full retirement age, early retirement age, or a delayed retirement age. Next slide, please. On this slide, it shows full retirement age at 62, benefit by year of birth. Full retirement age is the age when you will be able to collect your full retirement benefit amount. The full retirement age is 66 if you were born from 1943 to 1954. That's the first row of numbers on this chart. The full retirement age increases gradually if you were born from 1955 to 1960 until you reach 67. For anyone born at 1960 or later, full retirement benefits are payable at age 67. So this chart hasn't been updated in quite a while. They have kept the years of birth and the retirement ages the same. It is possible that they will increase those. That has been a discussion. If you decide you're going to do early retirement, you can get Social Security benefits as early as age 62. However, your benefit's going to be reduced if you start receiving benefits before your full retirement age. And this will affect your benefit amount. Once you start receiving that benefit amount, if you start receiving it before your full retirement age, you're going to get the amount. For example, you start receiving your full, if somebody at full retirement age 66 they decided to get their benefits at age 62. This chart is based on a $1,000 benefit per month. So they decided at age 62, they want to take their retirement. That's early retirement. They have 48 months between the time that they're age 62 to the time they are at full retirement age. So their $1,000 a month benefit is reduced to $750. That benefit does not increase when they turn their full retirement age. The benefit that you get when you start getting your benefits is the benefit you'll receive with cost of living increases for the duration of your Social Security retirement. You can also delay your retirement age. When you delay collecting benefits beyond your full retirement age, the amount of your retirement benefit will continue to increase up until age 70. So once you turn 70, there's no incentive to delay claiming, to delay claiming your Social Security. Once you turn age 70, you're at full retirement age, and because you've worked up to that point, you have increased your benefit amount. So when you start looking and planning for your benefits, you want to look at options of what happens if I decide I want to retire at 62? What if I retire at 65? What if I retire at 70? So that you have a variety of options and you can plan when a good time would be for you to retire. Next slide, please. So there's some things that can affect your benefit amount. Everyone's retirement is different. Beyond deciding when to receive retirement benefits, there's some other factors that can affect the benefits you get, whether you continue to work, the type of job you had, and if you had a pension from certain jobs. Continuing to work, if you continue to work and work beyond your full retirement age, if you do, that increases your future retirement benefit. Each extra year you work adds another year of earnings to your Social Security record. Higher lifetime earnings can mean higher benefits when you choose to receive the benefits. But keep in mind, that's only up to age 70. It doesn't change your earnings if you work beyond age 70. Then there's specific types of earnings that are looked at differently. While Social Security earnings are calculated the same way for most American workers, there are some types of earnings that have different rules. And those type of earnings could be farm work, household employment, such as a maid or a nanny, military service, railroad earnings, self-employment income, and any work outside of the United States. If you have any of these type of earnings, you need to talk with either the employer or your financial advisor to see how this is going to affect your retirement and your Social Security. The pensions and other factors that could be something you need to be aware of. Our pension and taxes have the potential impact on your retirement benefit. And if you have a pension from a job, specifically where you didn't pay Social Security taxes, this could possibly lower your retirement benefit. You might have to pay federal tax on your Social Security benefits in certain situations if there's additional income, or if you were in a specific job that requires additional taxes to be paid. So like I mentioned earlier, it's important that you start looking at and planning your retirement now. It's something you want to look at to see what you're ready for, plan for what age you want to start receiving it, what is going to be the most beneficial to you. And if there is a spouse in the picture and you're married, there are spousal benefits that you need to take a look at and compare with your benefits and what is going to be best for you, what is best for your spouse, what is the good time to take these. So those are the things you need to look at. If you're already receiving benefits, then you need to take a look at what you're getting and make sure that you're getting the best result from your choices. And if there's anything you can do to change those or adjust those to give you a better benefit amount, you need to meet with a financial advisor, a Social Security analyst, or depending on the information you're looking for, a tax professional to give you some more information and detailed information about your specific situation, because everybody is different. We all worked, or you worked somehow, even if you were a housewife, you still worked. But if you don't pay into the system working throughout time, you don't have a Social Security of your own. But if you're married and you were a housewife, you can still get the spousal benefits because your spouse worked. So that is another reason why it is good to look at all the benefits and see what you qualify for and when you qualify for it. Next slide, please. So we'll go on to talk a little bit about 2020 taxes. So the rules for 2020 are pretty much the same for 2019 so far. The IRS will continue updating the laws and making adjustments up through November. They have done it all the way through December in some prior years, but there isn't a whole lot on the table right now. So they're not going to change much, if at all. Right now, federal income is taxable. All income is federally taxable. Individual states do have their own rules on what income is taxable and what income isn't. There are 8 states that do not have any individual income tax: Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. These states do have sales and use taxes. They just don't have individual income tax. So don't get those confused because they are reported differently. The sales and use taxes are not a federal tax return thing. They are not by federal dates. The states have their own rules for those and when they're paid and how they're paid. So be sure also, if you're getting an American Indian, tribal income, native income, check with the people that you are doing your tax returns with and make sure that they understand that there are different tax treaties that the American Indians have with the federal government that give different rules to native income, specifically for the states. The states will have very specific rules on how to apply Native American income. Now, the federal return is the federal return. It's always done first. The state return follows the federal. Some states require a completely new return. Other states require they start with a taxable income and work from there. For an example of that would be New Mexico. New Mexico has special rules for American Indian income. The federal, it's taxable. On the state, in certain circumstances, it is not. Make sure that your tax professional understands those rules so that you are getting the best benefit you can on that tax return. Social Security income can be taxable if you earn more than the limits below. If you're under full retirement age, $18,240, you can earn anything below that before it becomes taxable. In your full year of retirement age, just that 1 year, you could earn up to $48,600. And anytime after full retirement age, there is no limit on income. Next slide, please. This is just another view of the full retirement age to show you where you might fall. Next slide, please. So now that we know that federal income is taxable and the states have different rules, American Indian income is different, the other thing you always need to be aware of is the filing status that you choose. And to determine your filing status, there are 5 different categories. Single, which is very basic, simple. You're not married, you're not married or legally separated. This is the second highest tax bracket. So if there's any way you qualify for any of the others, it's always better to use the others. The next thing we'll look at is head of household. This is an unmarried person who provides home for a qualifying child or relative, and it's a lower tax bracket. It's closer to the married filing joint tax bracket. But head of household, for the qualifying child and qualifying relative, that is your dependent. It's, like I said, it's a lower tax bracket. If you have someone living with you that you're taking care of, be sure to check the rules to determine if this person qualifies you for the head of household status. It is a much more favorable than single. And if you do qualify for head of household, there are other credits and deductions that you're going to most likely fall into the category of that will increase your refund or decrease your tax and increase your refund. The married filing joint is a married couple as of the end of the year. Legally married couple, you can have either one income or two, it doesn't matter. A spouse is not a dependent. A spouse is a spouse. It's a married filing joint. You have you and your spouse, or you have you, your spouse, and dependents. So the spouse is never a dependent. There is a married filing separate status. Now, married filing separate is when a married couple doesn't want to file together. It's the highest tax bracket there is. You lose a lot of credits and deductions when you file this status. However, there are certain circumstances where it is beneficial for a married couple to file this way. It is not difficult to have the person that is preparing your tax return to look at both categories of filing status. Do a married filing joint, do a married filing separate, see which one benefits you the most. You don't have to file, you have to file one or the other, but you're not stuck with married filing joint just because you're married. You can do a married filing separate if it benefits you, and there's no reason not to look at both of them. The final status is a qualifying widow or widower. This is for an individual whose spouse has passed away, and this is the filing status they can use for the first 2 years following the year the spouse died, providing that you meet the other requirements. And one of the other requirements is that you have a dependent child living in the home. You don't see qualifying widower very often, just because a spouse usually doesn't die when you still have young children in the home. However, it does happen. And the reason they say for the first 2 years following the year your spouse died is the year your spouse passes, you still file married filing joint, just like he was in the house or she was in the house all year. So take a look at your filing requirements and think about if you have anybody in the house besides yourself that you are taking care of, and you're not married and you're single. Look at the head of household status. See if you meet those other requirements that qualify you for this. Because we are seeing that there are a lot of elders now that are taking care of their grandchildren. And if you are providing if you're providing support for that child, you're living in your home, you could be qualified for the head of household status rather than single. And there are credits and deductions for you and those children. Next slide, please. So once you determine your filing status, then you start looking at filing requirements. There are what they call the minimum filing requirements. So you look at your income, and if you're single, you have just the one income to look at. If you're married filing joint and you both work, then you're going to have two. If you're head of household, you probably just have the one income. And that is a better tax bracket. There's more credits and deductions available to you. But the minimum filing requirement says that it increases a little bit at a time for the filing status. It is based on the filing status. And more elders are becoming head of household because they're taking care of their grandchildren and their children in some cases. So like I said before, be sure to check this to see if you qualify for this filing status. Keep in mind, if you have an unmarried child that lives with you, no matter what age they are, they live with you for the entire year, they could qualify you for the head of household status. And once you have got that down, you understand what your filing status is and what is best for you, then you look at your income. And if you're single and you have income under $12,400, you're under the age of 65, you're not required to file a tax return. Head of household, if you make under $18,650, you're not required to file a tax return. And under age 65 are larger numbers, are smaller numbers than if you hit over 65. Comparably, head of household at under 65 is $18,650. Anything under that, you don't have to file. Head of household over 65, you make $20,300. Anything under that, you don't have to file a return. Granted, these numbers are there. They do increase a little bit each year for cost of living. It is something that we generally look at this. It is combined income from both spouses. If you make less than this, you are not required to file a tax return, generally. There are a few exceptions, like if you're self-employed and your income is over 400, you're required to file a tax return based on the type of income, not the minimum filing requirement. So always be aware there is a minimum filing requirement. Also, just because you don't have to file a tax return, you want to take a look and see if filing a tax return is going to be beneficial. Just because you don't have to doesn't mean you can't. You can file a tax return to get a refund of credits and deductions that you are eligible for at that $23,000 income level, especially if you have children. There are deductions for earned income, there are deductions for college, there's deductions for your standard deduction, there's itemized, there's all kinds of different deductions and credits that you could qualify for. So you want to keep that in mind. And also, as I mentioned before, a portion of your Social Security benefits may become taxable if your income exceeds a certain tax, when income exceeds a taxpayer's base amount. Now, the base amount is determined by your filing status and your income. So you need to speak with somebody, a tax professional, a financial advisor, somebody that can verify what your minimum level is. So we have elders, once they look for that number because they want to work just enough to earn up to the limit of income before their Social Security becomes taxable. Because what they can do is work up to, let's say, $20,000 and stop before their Social Security becomes taxable. So the only taxable income they have is what they worked, not their Social Security. If you go over that, a portion of your Social Security can be taxable up to 85% of it. It will never be 100% taxable, but it could be up to 85% depending on other income. Next slide, please. So what we're seeing now is the IRS is sending letters out to people who did not file a 2018 or 19 tax return yet, and that did not receive the stimulus payment that came out earlier this year. You have until October 15th to go online to irs.gov and apply for the stimulus if you haven't received it. You can also wait and claim a refundable credit on your 2020 tax return. And there are two types of credits. There's a refundable credit and there is a non-refundable credit. A refundable credit is one that is applied to your tax liability first if you have one. If you don't have a tax liability, it is all refunded to you. If you have a tax liability, then the difference between the credit and what you owe will be refunded to you in a refund. Because of COVID-19, sorry, it skipped a line. The stimulus payment also is not taxable. I know they've gone back and forth about it would be, it wouldn't be, it would be, it wouldn't be, and they finally stopped at it wouldn't be. So that stimulus payment that we received is not taxable. So it will probably go in the return and off the return, a debit and a credit. So it's just, it was free money to you. A lot of people also received unemployment because of COVID-19. The unemployment is going to be treated just the same as any regular unemployment. So that is up to you to make sure that the federal taxes are withheld and state taxes, if allowed, in your state, so that you are covered at the end of the year. If you have extra income, like unemployment income with taxes that aren't being withheld, or you are wondering if you're going to have a tax liability, there are ways to look at your income now and find out what you're looking at owing, if you are. And somebody can sit with you and explain to you how to figure that out so that you can plan now. And if you're still working, you can have additional withholding withheld for the next 3 months to help cover that tax due at the end of the year. Or you could start putting money away to cover that tax due at the end of the year. And then next year, when you file your 2020 return, at that point, you can decide, this is what I need. You can plan for 2021 so you don't have to pay at the end of the tax year. Everybody's tax situation is different. Everybody has different income. You have different circumstances. You have different family lifestyles. You have different types of income. So you need to look at this individually with either a tax professional, or you can talk to a financial advisor, or you can talk to somebody that you trust that can help get you the answers you need for the upcoming tax year. I'm going to move on to Medicare. Next slide, please. So another thing that's coming up is we have Medicare open season, which starts October 15th. And let me go over a few of the Medicare basics. Medicare is a very complicated and convoluted system. There's different pieces and parts, and they all function different ways. And we're all being bombarded with the Advantage plan commercials, and Medicare Advantage takes this and it helps with this and it can help over here. They're all different. They all have different requirements and they all cover different things. Medicare it's the federal health insurance program, generally for people who are 65 or older. There are certain younger people with disabilities or people with end-stage renal disease that also can qualify for Medicare. There are three main parts to Medicare. Part A, which is your hospital insurance, that covers inpatient hospital stays, care in a skilled nursing facility, hospice care, and home health care. Medicare Part B, this is like your medical insurance, covers certain doctor services, outpatient care, medical supplies, and preventive services. Medicare Part D, this is your prescription drug program. It helps cover the cost of prescription drugs. Now, it doesn't cover all of the prescription drugs. Medicare doesn't cover everything. So it's important when you start to pick a Part D plan that you know what medication you're currently on and make sure that your plan that you're choosing will cover that. So what does Medicare cost? Well, there are lots of different variables to this question, but to give you just a basic idea, Medicare Part A is premium free for most people. We paid that premium during our working life. Out of your paycheck, you had a Medicare tax that you paid. That paid your Part A. So you don't have a premium for Part A now. They say it's free to you, but you really paid for it throughout your life. Medicare Part B, the standard premium for 2020 is $144.60 per month, and this premium will change over time as people in higher and lower tax brackets can pay different amounts, and this amount is withheld from your Social Security check if you're getting it. If you're not getting Social Security, then you're going to have to pay it out of pocket. Next slide, please. So now, when do you sign up for Medicare? Well, if you are getting Social Security, you start receiving Social Security at 62, all the way up to 65, then you will be automatically enrolled in a regular original Medicare. There's nothing you need to do. Medicare will send you a card in the mail in about 3 months in advance of the month in which you turn 65. If you're not receiving Social Security, then you need to sign up, and you need to start looking at this 2 to 3 months before the month that you turn 65. Your initial open enrollment period is the 6 months following the month of your 65th birthday, or when Medicare Part B start date. Medicare Part B is the one that you pay out of pocket if you're not receiving Social Security. So that is all based on if you start getting Medicare, you're not on Social Security. That's what they mean by your open enrollment period starts when your Medicare Part B starts. And you can go online, or you can go to the Social Security office and do all of this set up, but you need to make sure you do it 2 or 3 months in advance. The other date to remember, as I mentioned originally, open enrollment is October 15th through December 7th. This is the time to make changes to any existing plans, start looking at what's available. You see a lot out there about these Advantage plans and Medicare and all the different things, these new services that they're covering, the dental, the vision, hearing aids. Those 3 things specifically are not covered under original Medicare. They just aren't. Advantage plans are starting to cover them. The Advantage plans are starting to cover more and more things. Next slide, please. So again, how do you sign up for Medicare? If you're already receiving Social Security, you'll be enrolled in Original Medicare, which is Medicare Part A and B automatically. Like I said, there's nothing you need to do. You'll receive a red, white, and blue Medicare card in the mail, and without having to take any prior action to enroll in Medicare. If that situation applies to you, there's nothing else you need to do with Medicare. Your next step is to pick a Medigap plan and a Part D plan if you're going to use those. I'll explain what a Medigap plan is in a moment. If you're not receiving Social Security, you will need to go in, you will be enrolled in Medicare A automatically, but you need to enroll in Part B, which is your medical coverage part of Medicare, and Part D on your own. So, what is a Medigap plan? A Medigap plan fills in the gaps in Original Medicare. What this does is Medicare, the Original Medicare A and Part B, will pay for certain things. There are deductibles and there are copays. A Medigap or a supplemental plan fills in those gaps in Medicare. They will pay the copays, they will pay the deductibles, they will pay anything Medicare doesn't. Now, these plans range considerably in price depending on where you live, but the national average for someone turning 65 is around $110 a month. And some states are $20 to $40 a month lower than that. Some states are $20 to $40 a month higher than that. But that plan would, you add it to your Medicare, so they're still going to pull out the $144.60 for Medicare. And you're going to pay the additional supplemental cost on your own out of pocket. But when you go to the doctor, everything is covered at 100%. Whatever Medicare doesn't cover, your supplement will. Keep in mind, these are more expensive than the Advantage plans, and they are different. And I will get into that shortly. Now, Part D is your prescription drug coverage. Your prescription drug coverage, this is going to be an additional cost to you, and you need to pick a different, there's all kinds of different plans, so you need to look at the different plans. Make sure you look at the plans that are going to cover the medications that you're currently on and anything you think you might start to take. Now, you can change these plans once a year, but you need to be sure you have it, especially if you have a supplemental or a Medigap plan, because they do not include prescription drug medications. An Advantage plan can. Part D, national average premiums are around $35 to $50 a month, and there are plans as low as $12 to $15 a month, and some are a little higher. It just depends on what the rates are in that state that you're living in. There are penalties for not having prescription drug coverage that continue to accumulate until you have a prescription drug plan in place. Keep that in mind. So now we'll look at the difference between a Medigap plan and a Medicare Advantage plan. We see a lot of commercials, and it's a constant bombardment of Advantage plan, Advantage plan, Advantage plan. They cover this, and they cover that, and they cover this. Well, they do. They cover a lot of things that a supplement won't. Like I said, dental, vision, hearing aids. But Medigap plans are not Medicare Advantage plans. And Advantage plans aren't Medigap or supplement plans. The basic level, the biggest difference is Medigap plans work with your Medicare. So you still have your Medicare. They supplement it. They work with it. While Advantage plans take the place of Medicare. So Advantage plans you don't have Medicare anymore. You have just that Advantage plan. And that Advantage plan takes the place of your Medicare. Now, there are good points and bad points to that. Now, for Medigap plans, a supplemental plan works with Medicare, not in place of it. A Medigap plan, you can use it anywhere that accepts Medicare, any doctor that accepts Medicare. Now, the premiums are a little higher. They are higher than an Advantage plan. Very few out-of-pocket costs. Your out-of-pocket costs are going to be your actual premium and your prescription copays. It's also guaranteed renewable. It's never canceled. Your benefits never change. As long as you pay your premium, it's always there. Like I said, coverage doesn't change. You can always use it, always stays the same. Now, you can switch from a Medigap plan to an Advantage plan without any medical questions being asked. You cannot, the only time you qualify for a Medigap plan or a supplemental plan without having to answer medical questions is during your initial enrollment period. After that, if you go ahead and you don't get a supplement and you go into a Medicare Advantage plan and then decide, oh, you don't want this, you want the supplement instead, then you have to answer a medical questionnaire, and they have to actually accept it medically for you to qualify for that plan. So that's the Medigap, that's your supplement. So now you have a Medicare Advantage plan, and this is where all those commercials on TV are talking. It takes the place of Medicare. You have to work within a network. Their doctors, either an HMO or a PPO or their network of providers, where they are, yes, the premiums are lower, but you have more out of pocket. You have more co-pays and those type of things. But the premiums are lower, and premiums can be zero, depending on where you are. But the Advantage plans, those networks are renewed annually, which means coverage networks can change, benefits can change, doctors will change. So there's a little bit, if you want to keep, if this is where you start looking at the Advantage and the supplement and which one you fit into better. Can you pay more out of pocket initially, or can you pay more out of pocket down the line? That's where the question comes in. And if you want to switch from an Advantage plan to a Medigap plan, like I mentioned before, you have to qualify medically. To go from a Advantage plan, to go from a Medigap plan to a Medicare plan to an Advantage plan, there might be a few medical questions, but it's going to be easier to get into those plans. They're going to cost you less, but then you have to deal with their coverage networks, their doctors, those type of things. So it's up to you, really, which one that you prefer to have. But be sure you ask the questions. Be sure that you understand what your options are so that you get the best benefit for yourself. Next slide, please. So in closing, just a few dates to remember. October 15th, final day to apply for that stimulus payment if you haven't gotten it already, or if you want to wait to get your refundable credit at the end of the year. Just remember to mention that when you get your taxes done. October 31st is the final day for census participation. Please, please fill out that census form and get it in. It is going to provide more money and more programs and more benefits for the Native communities. And that's what we need. The benefits are few and far between. The more people that are counted, the more people they know are there, the more services that we're going to be able to provide. Keep in mind, apply or start looking at your Social Security at least 2 or 3 months before you turn 62 or the age you want to start collecting Social Security. It's never too early to look at it. Never too early to start asking the questions. What is going to happen when I turn 65? What is going to happen when I turn 63? I want to work till I'm 64. What happens then? What happens if I retire and my spouse works, or if my spouse retires and I work? Those are the questions you need to know. And then again, the whole topic of today was voting, November 3rd. Get out there, get your vote counted. As Desiree said, everybody matters. We all have a voice. We all need to make our voices heard and let them know that the Native communities are not going to stand by and just be ignored anymore. We need to be heard. We need to be represented. And thank you for your time. If there's any questions, I'll be happy to answer them.
So we do have a couple. Thank you so much, Cheryl. We've got a moment or two to go ahead and respond. I think these are a couple quick questions. The first one is, how secure is the SSA website where you can check your contributions and more online? Many are leery of sharing the detailed information it asks for.
The Social Security website is extremely secure. You can, your account, it's very hard to hack it. They will not allow, when you apply for Social Security, they make it very clear that that website is for you and you only. You should not have anybody get into that website besides yourself. It is very, you have your username, your password. They ask some very specific questions that only you would know the answer to. And so unless somebody has been around you forever and knows exactly where you've lived every time in your life, because they do ask things like, have you ever lived at this address? And they'll list 3 or 4 addresses. And if you don't choose the right one, you're locked out automatically. To get back into your account, you have to speak with them directly. And again, they'll ask you those questions that are very specific to you that nobody's going to have the answer to. If you do want help with doing your Social Security, you can, if you have somebody that you can trust and that you do trust, you can make arrangements for them to help you with that. But Social Security does not recommend you share that information with anybody. So it is extremely secure.
Great, thank you so much. We've got another one. Does your retirement eligibility ever go away if you don't claim it by a certain age and there has been many years since you worked?
No, it's always there. Your Social Security will sit there until you claim it.
Fantastic. We've got one more. This talks a little bit more about the census. If someone applied many months ago to be an enumerator but never heard back, what do you suggest? Are enumerators still being hired, especially in Indian country?
They may be. I'm not sure if they are or not, but I would go to the website and contact them. There are different phone numbers to call and find out if they are still hiring. And depending on where you are, you could actually check with your tribal chapter house or your tribal council. And they should be able to tell you who is the enumerator for that area.
Fantastic. And those are all the questions. So thank you so much.
You're very welcome. If anybody has any other questions, even after the fact, just send us an email. We'd be happy to answer them.
Can you answer this one? I think I know the answer, but it's, would someone qualify for Social Security if they worked for the federal government, or would that be considered double dipping?
No, it depends on the type of job you had with the government. If you had withholding on your W-2 that was federal income tax withholding and Social Security withholding, you would qualify for Social Security. But you need to check with somebody either at the government agency where you worked, or a financial advisor, tax professional, somebody that could answer that specifically for your organization and your status. Because what could happen is you have 2 different types of money and 2 different types of retirement that you just have to determine which one you take first and which one you take second.
Fantastic. Thank you so much.
And if you don't have any more questions for me, I am going to thank you for your time